Oh boy, last week I created a video about creating a dividend income for life, and I pretty much told you you should probably not invest in high yield stocks and rather focus on low yield high growth stocks to generate that dividend income. I know, kind of crazy concept. If you want to know more about it though, I do have a webinar. You can go in the link description below or right there. It's dividendstocksrock.com/dividend-income. So on this webinar that will happen on November 2nd, I will discuss how to select those low yield high growth stocks, how to build your portfolio, but also and most importantly, how to manage those withdrawals so you can create your dividend income for life. Dividend growth investors, bonjour. My name is Mike Leroux and I'm the founder of Dividend Stocks Rock. I'm also a passionate investor and I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And today I thought, okay, so I've discussed low yield high growth stocks theory. So now let's go into some interesting Canadian picks. And next week, obviously, I'm going to do the same thing for the US companies. Obviously, I could have discussed Alimentation Couche-Tard, but I already have videos on it. So you can find them in the link description below or across my channel. Don't forget to give me a thumbs up and subscribe to the channel while you're at it, just to make sure that you do not miss our Thursday morning video. But I thought, okay, so Alimentation Couche-Tard, the case has been made. I've been talking about it for at least 10 years now. If you haven't considered investing in it, there's nothing I can do for you. So let's take a look at other type of businesses in other sectors that show the same profile, and most importantly, I still believe that they will be around the next 5 and 10 years. So in 10 years from now, I'll be able to do another video, review them and show you, hey, see, they were great. So instead of looking at the past, I can actually tell you a little bit more about the companies that I love. Obviously, those are not buy or sell recommendation. You must do your due diligence before you invest in any stocks. I am not liable for anything here. All right, so let's get started, shall we? First one of my favorite financial stock in Canada, and no, it's not a bank, it's actually Brookfield Corporation. This one, fair warning, it is a very complicated company to understand. They went through multiple splits, multiple spin-offs, multiple operation altogether. They used to be known as BAM, Brookfield Asset Management, but now BAM is just the asset light version. Now I want to look at the asset heavy version, Brookfield Corporation, ticker BN.TO or BN because it trades on both markets. And as you can see here on the dividend triangle, there's a problem here because we see that the dividend got caught in 22. No, it's not. Here's the thing, Brookfield, very complex company. They spun off Brookfield Asset Management outside of the business. They created a whole new ticker. They split the dividend payment, and then the investors received shares, but they did not get a dividend cut. So it's super important to understand. So as you can see, since 2014, it's always going up. So that's a very good news for the company. It grows all the time. So why do I like Brookfield Corporation so much? And full disclaimer, I do have it in my portfolio. Obviously, when you look at the revenue growth, it's pretty steady. So it's growing all the time. But for the earnings, it's pretty shaky, right? It goes up, it goes down, and it's also due to their complexity of their business model. Speaking of which, Brookfield Corporation is an asset-heavy alternative asset manager. Kind of crazy. So asset-heavy means that they not only get the capital from institutional and retail investors, so pension plans, big companies, you and I can invest into Brookfield funds or products, but they also use their own capital. That's why we called it asset-heavy, is they're making a fee on the assets under management, so the money they manage for you and other investors, but they also make money when they're selling an asset at a profit because they put their own capital coming from their pockets. As you can see here, we have multiple ways to grow here because Brookfield Corporation invests in so many different companies. So we have Brookfield Renewable that we already know, 48% ownership. We have Brookfield Infrastructure, 27% ownership. Then they have some private equity, so they're making deals and making acquisitions on businesses. Again, Brookfield Business Partners, 75% ownership. Then they have real estate. A few years ago, maybe you were a holder of Brookfield property property group that used to be traded, but after the pandemic, what they did is they saw the shares of Brookfield Property Partners and they thought it's way too low, so let's use our huge amount of capital and buy it back, make it private, and now making all the money in their pockets. And they do that a lot. They have also asset management, which is Brookfield Asset Management, 75% ownership. So as you can see, they are pretty much everywhere. They also have their own business with Oaktree. They do reinsurance businesses, but I mean, there was like so many things here, I could not put everything. The key about Brookfield Corporation is they have a long-term mindset. They invest for the future. They do not invest to make you happy in the next quarter. They invest to make you happy in the next 10, 15, 20 years. They have a long track record of success, and most of the time when there are clouds around, when there's volatility around, this is where Brookfield is at its best because they're always having a lot of dry powder on the side. And now is the time to invest and make great deals when asset values are depreciated, and this is exactly what they do. Moving on to the next one, TFI International. The first time I discussed TFI, it was in 2016 at Dividend Stocks Rocks, obviously. I did a report on them. I told them that it was like on my buy list. It was like a strong buy. And as you can see, I was pretty right. The company went very high, very fast. Now it's like hovering, not too sure what's going on, and it's completely normal. When you look at the dividend triangle, you also see that revenues and earnings are taking a slight dip. That's also normal because the transportation, the trucking business is cyclical. So whenever there is a down cycle in the economy, so when businesses are like investing a bit less, consumers are looking at their wallet and they're not tempted to buy more goods, when the economy is slowing down, obviously the trucking business is also slowing down, which I think makes it a pretty good, interesting entry point at this time, where the company, one of its best strengths is to grow by acquisition. So they have done over 100 acquisitions since 2008. How they do that? Well, it's quite simple. They have their own business model, and the trucking business is highly fragmented, meaning that there's a bunch of small trucker company here that have their own route, they have their own clients, and whenever it's slowing down, maybe they're not well diversified, maybe they do not benefit from economies of scale and the power of having a network, which TFI has across Canada, across the US, and now in Mexico. Well, then TFI comes in and say, hey, how about I buy your route, I buy your client, and then I make it whole with TFI. And most of the time when there's a crisis in the economy, TFI just makes a bunch of acquisition, and this is how they grow. What I like about their business model is they have a good diversification between those truckloads. So those like when a client is asking to transport enough goods to rent a complete truck or less than a truckload, which is more profitable if you can have that economies of scales where your truck is charging more because it's not a full truckload. But then what they do is they make sure that the truck is completely filled in. But if you have a wide network with a lot of clients and a lot of routes, it is possible to pack up your truck but charge everybody like it was just a portion of the truckload. So then you're asking for a higher price, but on your side, you're moving truckloads anyways. So being able to do that will improve your margin and will make you a lot richer while your clients are gonna be super happy anyway. They also have package and courier and logistics. So they're well diversified and they focus on margin. Last year or 2 years ago, they sold a part of their business where it was a lot more about truckload and it was less profitable than the rest of the other business segment. And they just decided to sell that part and focus on where they make most margin. And this is how they are able to grow their revenue, grow their earnings, and obviously grow their dividend. Keep in mind, TFI a little bit trickier than Brookfield Corporation. This one is definitely moving a little bit more up and down when there are volatilities on the market. Moving on to a very stable company that I rarely talk about, but I really like it, and it's rated as a buy at the SR for several years because it's a rare business in the material sector that actually makes sense to invest as a dividend growth investor. This one is Stella-Jones SJ.TO. As you can see on the revenue growth, on the dividend triangle, the revenue is increasing all the time. The earnings per share is pretty stable, going up all the time as well. And obviously, over the past 10 years, we see that the dividend increases steadily every single time. What happened? Well, the stock price was close to 20 bucks. Now it's close to $65, and the business is always growing. So how can a lumber company can grow and be as stable? Because when you're thinking about lumber, you're thinking about something that would go through economic cycles, and whenever there's like not too much renovations, and then boom, or housing construction, the stock would go down. But here's the thing, they're also selling a lot more utility poles and railway ties than anything else. So the three segments for Stella-Jones are utility poles, railway ties, and then they have like a roughly 20-24% of their business coming from the retail lumber for like housing, construction, and renovation. So utility poles, railway ties, thinking about natural catastrophe, regular maintenance, wildfires, hell, we have a very solid business here where there's always demand for that type of product, and it's a good thing because they're the biggest player in that industry. On top of that, they always grow by acquisition at the same time, so they have a lot of growth vectors coming from organic growth, from the constant demands for maintenance, the railroads, and also utility poles. Natural catastrophes helping actually to the mix, and then they are still able to grow through acquisition as well. So that makes Stella-Jones a very stable yet a growth-oriented company in the material sector. Well, it's really hard to find a business that is able to increase its dividend every single year. Moving on to the last one, but definitely not the least, Dollorama. And Dollorama has been flying under the radar of many, especially among dividend investors, because the yield is ridiculous. But here's the thing, as much as the yield of Dollorama is ridiculous, if you look at that dividend triangle, it is also ridiculously good. Everything is going up every single year. That is kind of crazy. What's their secret? Well, scale. They're opening so many stores all the time, and they have this strong brand across Canada, but they're also expanding outside of Canada now, which makes it very interesting. On top of that, it is a recession-resistant business. So when we talk about recession-resistant, it means that revenues are likely going to continue to go up even if consumers are spending less. Why? Because they are going to go to Dollorama before they go to the nice shops where they're gonna buy a bunch of stuff. They're gonna go to Dollorama to ensure that they get the best bang for their buck, and this is the promise Dollorama makes to their customers. So as you can see here, what is quite interesting is that they're not only very strong in Canada, but now they're growing towards the United States, they're growing towards South America as well. And their best way to do that is to benefit from their economies of scale and open new stores. This is the story behind Dollorama. Obviously, there's a lot more competition in the US, but from Canada, and also like that experience in South America could be quite interesting, because we're talking about like small ticket items where everybody needs them, and that should support the growth story moving forward. I was definitely a bit skeptical when I looked at Dollorama a few years ago, and I should have definitely invested in this one because it definitely fits my profile of low yield, high growth stocks. I must admit, to be honest, this one didn't hit my radar hard enough, so I was tempted to invest. But I think that there's still a lot of room to grow, especially in a difficult time when you're like scared of what's gonna happen in the market, if you're not too sure about your holdings. If one company will do well in a recession, I'm thinking Dollorama, that's obvious. If you wanna have like more example, and most importantly, how to find those low yield, high growth stocks and how to manage your portfolio to generate your income for life, just register to the webinar on November 2nd. The webinar is free. The replay will be sent to all registrants anyway, so if you cannot attend to the live event, don't worry about it. I'm gonna send you the replay with the slides and everything, so you're not gonna miss anything. But if you're at the live event, you're gonna have a blast because we're doing like a 1-hour Q&A where you can ask me any kind of questions about any kind of stocks or strategy, and I'm just there to help you out. So just go to dividendstocksrock.com/dividend-income, register for free, and we're gonna see each other on November 2nd. Until then, don't forget to stay invested.